Now, the objectives of today's course will be 1, the SDG funding gap, 2, the role of impact investing in achieving the SDGs, and 3, the potential gender lens investing in achieving, this sustainable development goals. Now, of course, before we do anything, we have to know what sustainable development goals are. And we have to go back to history a little bit and look at what were all the initiatives that had happened before then and what made it get started. So the Sustainable Development Goals really were an evolution from the Millennium Development Goals, MDGs, which had previously sort of fallen short. This MDGs came around 15 years ago, and there was a lot of excitement around it, but unfortunately they did not meet the goals they were looking for. And also a big issue was looking for the funding available for MDGs, and somehow the United Nations, the various bodies, could not rally people around it. And it really became something that relied heavily on the overseas development agencies, basically the developed country, the rich countries, to finance all of that. So what SDG came out of was, how do we actually bring a whole ecosystem of corporates, public, private sector, civil society, everyone to be a part of it, and have a voice and a way to help meet these goals. Now, the Sustainable Development Goals, it actually included more criteria to address poverty, and they have 169 aligned targets with specific goals. And SDGs, basically all of them, the 17 SDGs, they cover 3 broad areas: economic growth, social inclusion, and the environmental protection. And these were created for all countries. So it really wasn't one of those things where if you are a developed country, you were not a part of it, and you had to give money to the developing countries, which was obviously the usual kind of the development model. But it really was, hey, we're all in it together, and we will all play our roles in different ways. So there's also a huge component to encourage participation of the private sector, with key focus on mobilizing financial resources. And this has been a big, big, big focus. And I think, frankly, the reason people are all excited about it, and you'll see a lot of corporates who are excited about it, is really because of this. Because now, all of a sudden, they do feel like there's a role, not just by their money, but their action as well, and how they do their business practices. So this is off to a great start. And I think what's really interesting is this holistic approach is recognizing that ending poverty must go hand in hand with strategies that build economic growth and address a range of social and environmental issues as well. While the SDGs were sort of, everyone was starting to embrace it, one of the things that became very, very evident was the fact that there was actually a big funding gap. I mean, we want to achieve these, wonderful outcomes on the 17 SDGs that were formed, but how do we pay for it? And if you look at it, there was really a funding gap of almost, $5 to $7 trillion, and that's a lot of money. And if you look at philanthropy, the grants, that's like drop in the bucket next to it, because that's really roughly around 360 billion. If you look at the total development, the aid, that's half of that. So the funding gap is massive, right? So how do we actually achieve this? So this is, frankly, I would say, the crux of the discussion, and for the other modules that we'll be going through, because again, the financing of the SDGs really need to be understood and addressed if we are to make sure that we have SDGs that are working for all by 2030. Now, I always like to show this next slide, which is really looking at the potential, for the market. Now, it's an interesting slide if you think about it, just putting things in perspective, and also to give you an idea, what it really means. I mean, SDG, we need $5 to $7 trillion. Say, okay, roughly about 6 trillion. Okay, so where is this money going to come from? So if you look at it, in the world market, so any given day, the capital markets, it's a market that's worth about, $70 trillion. So if you remember the GDP, world GDP is around that. So it's around the same number. Now, interestingly, over the course of the last 20 years, out of that, there's a certain portion that has been going into sort of the what we kind of call the ESG, which is the looking at the environmental, social, and governance. Some of this is starting to go into the social responsible investment, where you don't invest in tobacco, guns, and all that. But all of that in comparison, if you look at on the right side of the slide, philanthropy, it really is a drop in the bucket, because we have so much capital in the capital markets, but on the philanthropy side, it's really not much there. You see 70 trillion on one side, and then on this side, you're literally looking at about 300 billion. So it really is, it's a massive, massive difference. So what we really needed was something in between that is going to really embrace the social side of it, and really sort of look at how to bring in the financial aspect and make sure the market can come in and play a role in achieving these social and environmental goals. And that is where impact investing came in, and we're going to go a little bit deeper on that. But the size of the market when the term was coined was really about $1 trillion. So interestingly, even if impact investing was supposed to be $1 trillion by 2020, which it looks like it'll be a little short of that, you still need much more than that, for the Sustainable Development Goals. But the good news is, impact investing, came in as a discipline to really be addressing this. So, what is impact investing? Now, impact investing, if you look at the term itself, it's a very simple definition. It says investment intended to create positive social impact beyond financial return. Now, let me pause here for a minute and just sort of give you a little bit of background how this came about. And it's it's kind of exciting for me, because obviously I was part of the team and who kind of made this happen in this whole impact investing space and the movement, etc. So 2008, if you remember, the financial crisis happened, and I always like to remind people, interesting kind of note at that is, while people lost incredible amount of money in the financial markets, if you had your money at that point in something like a microfinance, you would have still gotten about 14% return on average. Why? Because it's simple finance. You would have had your money diversified into something which was not at that point linked to the market. So, which is very, very interesting. So if you think about it, forget doing good or whatnot. This is pure and simple finance. It's pure and simple money management that you need to think about diversifying even your portfolio. So really, impact investing is very interestingly, is really in the essence of it is that, which is really looking at having financial return with an intention, and the intention is the big word, to create social and positive and financial impact, as you have a financial return as well. And I remember this, when I was a group that Rockefeller Foundation brought together. So this is in 2009, early 2009, and we were invited to Bellagio in Italy. Beautiful gathering. If you ever get an invitation, you definitely should go. And there were 20 of us, where we basically, from various disciplines, and we basically were brought together to discuss, what this is and how this impact investing going to happen. What does it mean? And how do we actually each play a role in it? So it was quite exciting, because there were people, who were heading up stock exchanges, big financial institutions, etc. But I have to say that the common theme was everyone had a sense of optimism that, all of a sudden they had a place, they had a place to play a role, in kind of doing something good, doing what they do, being a banker, a lawyer being a lawyer. And so, it's not that you have to put on a different identity to go and do good. No, you do what you're doing, but let's do it to create social and environmental good. So it was really, truly exciting. And I think, one of the most memorable moments of my life, because obviously that gave birth to Impact Investment Exchange. So I think the whole premise of impact investing is a very simple one. So let's start. Let's start with the basics. So what is impact investing? So impact investing, if you look at it, it is actually, I would say, an extension of traditional investment, and also an extension of philanthropy. So if you look at traditional investment in this chart, you have, you put money into a business and you get the financial return, right? Very simple. If you look at grants or donation, you put it into a non-government organization, that's NGO, or you put into a civil society organization, and then you'll get some sort of a social, return or environmental return. Now, until now, these were not quantified. You actually would get, maybe if you give large amounts of money as a donor or a big philanthropist, you will get what's known as a monitoring evaluation report, M&E, which is a backward looking, not really forward looking. So and if you didn't meet the goals, so be it. So interestingly, that's usually how obviously the development space that has developed. Now, impact investing really sits in the middle, where you are making an investment, and this is actually investment. You think of it in terms of expecting a financial return, but then also in terms of looking at expecting that the intention of that financial investment is the fact that this will stimulate the social and the environmental return as well. So really, if you look at the chart, the impact enterprise is giving you 2 to 3 sets of return: the financial, social, and environmental. The best is if you get all 3, but at least the financial and social, or financial and environmental. And the interesting thing is the fact that looking at really focusing on the sustainability, of this enterprise, to make sure that with the investment that the enterprise is getting, that they can actually grow and they don't need that continuous, flow of capital as grant funding would usually need. So that's what impact investing is. And if you look at the origins of impact investing, again, we can look at it from one angle, from the SDGs, but the other way to look at it is also from the financial markets. I mean, how did impact investing emerge? If you look, from that angle, the movement really started, I would say, with the social responsible investment, right? So in the early 1970s, this is when the socially responsible investment was coming up. And also, if you remember, this was also the time of kind of social turmoil in terms of in the U.S. there was Vietnam War going on, and so there was a lot of sort of, I would say, the social, social movement also played a role in this, and people really consciously trying to do good. And it really was seen at that point as, okay, this is a first move into kind of trying to make traditional investments think about things differently. It's like, okay, don't invest in guns, so we can stop war. Don't invest in tobacco, et cetera, et cetera. And then in the 70s, there was an interesting movement that happened in the development space. All of a sudden there was a new concept called microfinance. So again, we say the 70s because really this was when SEVA, the Self-Employment Women's Association, they're the ones, I would say, one of the pioneers in this, who started off in India. But of course, then it was replicated in many countries, including the most famous one is Grameen in Bangladesh, where I worked in its early days. And it really was, for the first time, you're seeing kind of the flavors of finance coming into the development space, and also the flavors of, I would say, which is something very powerful, which is women, having access to finance, and women actually having decision over the money and how she grew the money by just getting these small loans, which they didn't have access to. And then, again, in kind of the late 70s, you see it in the US quite a bit, which was the Community Development Financial Institutions, CDFIs, started coming up. And this still is very, very strong in the US, and they're wonderful organizations. They're basically financial institutions which give loans to underserved communities, and, really helping, these underserved communities or even enterprises which the traditional banks will not, find ways, frankly, or they just cannot work with them. So CDFI really kind of played a big role in this. And then in the 90s, it became very popular, again, on the corporate side, to start talking about CSR, the corporate social responsibility. Now, interestingly, in the 90s, CSR was still quite different. It really still was just more seen as something that the employees would do almost as a charity, or the organization, okay, the organization will just give money to some charity. So that is also interestingly now changing. So, and we will talk about that quite a bit. So again, it really was 2008, 2009 when the whole impact investing, the term and the movement solidified under the guidance of Rockefeller Foundation. So, and I do give Rockefeller Foundation an incredible amount of credit because they're the ones who made this happen, and this is why we are sitting down today and talking about it. So it's wonderful that they took the leadership on it. So now, if you look at the next slide in terms of the spectrum of impact investing, this also really gives you a very clear idea of where it sits. So if you look at this graph, on the left side you have grants, on the right side you have commercial capital, and impact investing really sits in the middle. So if you look at it in the grant, it really is the traditional philanthropy or venture philanthropy. Venture philanthropy means where you're actually giving some money and for a business to start off, but you don't expect it to get back anything. So again, that's venture philanthropy. But and the left side is with expectation of no financial gain, and really sort of thinking that you will get that social and the environmental impact. On the right side, in extreme right, of course, is the commercial capital. And this is where, under that, as we just discussed, some of the movements started happening in terms of the socially responsible investment. And then of course, and then you have the extreme of the traditional capital with just the financial return. Impact investing, sits very much in the middle. And you do see that, in terms of the community debt financing, as I just discussed, and then even the angel investment and all that, they started slowly coming in, really encouraging enterprises to not only look at doing social good, but also looking at doing having a financial return and being sustainable about it. Now, this is something interesting to sort of think about how impact investing, even when it started, it really was more about looking at it from organization making sure the mission of it, it stays correct, the social environmental impact is happening, and then seeing that there is a financial return is a part of that. So I find it very, very interesting. But we'll also talk about that, how sometimes it's a little different in various geography and how this is viewed. Now, how does impact investing differ, from these other things that we just talked about in terms of venture philanthropy or social responsible investment or ESG? So again, the traditional investment is about just one objective, which is financial return. So that is the first and foremost. And sometimes now, as you see, the organizations which are focused on this, which is majority of the organizations in this world, they do start sort of thinking about CSR. They start thinking about ESG, but those are really, really, really things that they think about much, much, much later. So, but of course, interestingly, there has been movement from the investment side where investors have been pushing for this, saying, hey, if you are a company that you're producing cigarettes, I'm not going to invest in you. You go ahead and invest in cigarettes, that's fine, but I'm not investing. So the movement, the pressure from the investor side, and that gave birth to obviously the social responsible investment. And then the same way, pressure from the philanthropists sort of saying, hey, how about looking at what you're doing in a more financially sustainable way? I'll just give you the money, you don't have to return it, but please think of it as a business rather than just having a traditional NGO. And that's where venture philanthropy was. So there were many ways people were coming at it, which I think is absolutely wonderful. And I think in some ways, if you look at it, that's sort of kind of the essence of this sustainable development goal as well, right? So where everyone sort of finds a role. And what impact investing did was really take all of this and sort of say, hey, great, and let's sort of see if all of that can be pulled together and have a discipline where you say that you're going to have the financial return, but the intention of the investment that you're making is not only getting that return, but really having the social and the environmental part of it. And again, as you see in this slide, really looking at the beyond the traditional investment and looking at the intentionality of it, and that's very, very important because we are looking at in terms of the SDGs. If you look at the SDGs in this chart, sort of no poverty, zero hunger, good health, quality of education. These are many of these SDGs, from SDG 1 to 8. The indicators which are there, they very much sort of fall into all the things that impact investing is trying to do. So it is very, very, very interesting that this whole notion of intentionality, really does, make people do things differently. And all of a sudden, you're like, whoa, okay, I'm actually making these investments that can meet a lot of these SDG goals. So it really is how you can approach it. Now, if you look at the drivers, of impact investing, and it's interesting drivers. You have this is similar to the chart you saw a little while earlier, in terms of the spectrum. So you have, of course, in that case, you saw in terms of looking at donation versus investment. And here, let's look at it in terms of the enterprises, right? You have the pure charities on the left hand, who obviously make use of those grants, and then you have the traditional business. Now, the drivers of these are very interesting. On the right side, the driver is just social value. I just want to do good. I don't care, what it means. But the problem with that is you have to go and keep on trying to get donation and convince, frankly, the people who are sitting on the right side of the traditional businesses, beg and plead if they'll give some money so you can do this charity work. And it's kind of, sometimes it can be very, very difficult. I mean, it's very difficult to fundraise. You may think this is the most wonderful thing, that the most pressing need, and which it is. It probably is the most pressing need. But then you can't do anything about it, because you need to get the folks on the right side, in the traditional business, to give the money to you and kind of tug on their heart strings and hope and pray that they do it. So I think we need to kind of change that. I mean, why do we need to be at the whim of someone who has a lot of money and they want to do something, and you on this side have to do something that they want, whether it makes sense or not, on the social side. So frankly, that's why if you kind of go look at the chart, on right side, the primary driver, on the right side, the primary driver is the financial value. Left side, the primary driver is the social value. And if you're sitting in the middle, and it says here social enterprise, it's an enterprise, frankly, who is giving this triple bottom line. And you'll see me throughout my various lectures, I interchangeably use it. There was social enterprise was a big word in the early days of impact investing. Now most of the people are saying impact enterprise, but the different parts of the world, they still use social enterprise. So we interchangeably use it in all the various lectures, so just bear with me. So here it's a social enterprise. So anyway, so it's social enterprise, the twin drivers really are achieving social impact along with the financial return. And I think what's nice about it is the fact that, you really are in a position to sit across the table and tell someone, what, we need to have, clean water in this rural village in Indonesia. And this is not a charity. You're going to make an investment that have this wonderful technology, which will not only help these people get clean water, and I'm going to charge them a small fee. I'm going to make sure they know they have the capacity to pay for it. I will also think about the various pricing models, how they can pay for it, and make sure that they have a livelihood that goes with it. And then I'm going to grow it to the next village, and the next village, and the next country. So it really is looking at it as a business and the growth opportunity as a business, but obviously having that social, side go along with it. Now, what we like to do is look at, everything, and you should kind of start thinking along those lines as well, which is, what does it really mean, to have an enterprise, which is thinking like this, which it wants to actually achieve these different things. And one of the big lessons for us, over the last 10 years of doing this, is that you really need to approach, impact investing, not just as, oh, I'm just making this investment, into this organization. Okay, great. No, you really need to think of it in terms of the entire value chain. Okay, what we call the social capital markets value chain. So if you look at this, the value chain where you just put some money into an enterprise, that really is the seed capital, right? So this is where you're giving a little bit of money, the organization can start the work and start, growing and creating the impact, the financial return, etc. But then they will hit a wall, because again, you need the next stage of funding as well to go to the next stage. And this is no different from how traditional companies grow. So we have to create, and which we did in Asia from IIX, this entire sort of the value chain, of social capital markets. If this is going to be a new way of looking things, and it has to sort of be there to make sure that we are achieving the sustainable development goals. So you need to have the seed capital, the early capital, the growth capital, the bridge capital, and then obviously the ultimately, going and being part of the market. So what we will also do in the subsequent modules is really go deep into all of this. What does it really mean, to create this, this entire social capital markets value chain? Because if you don't have this value chain, the organizations cannot journey through it, and they will just fail, at the seed stage. So it's not just about, having incubators of entrepreneurs. That's a great start, but they need to go to the next stage, and the stage after, and the stage after. And it is not easy, to create this entire ecosystem and infrastructure, but we did it. And I definitely, want each one of you to think about, how you view this and where you fit into this, in the value chain of this. Now, interestingly, if you look at it from IIX point of view, just a flavor of it, just to put things in context, what we have done in terms of looking at this value chain, when we started off, in 2009. It really was the Rockefeller Foundation basically said, what, go and do something that's going to basically start this whole movement. So I started off sort of saying, hey, we're going to create this impact, exchange. So, and that's what we focused a lot on. But at the same time, and that obviously is if you look at it in the right-hand corner, but at the same time, we really focused on creating the entire value chain of it. So right now, from IIX side, if you look at it any given day, we have work that we have done or continue to do in doing accelerators. We're again working with organizations and making sure that they're ready to go and get that, seed capital and that early stage capital. And then we have an equity crowdfunding platform called Impact Partners, which is, I think it's one of the largest in the world. Obviously in Asia, we're the only ones. And which is focused on the impact side. So that has been quite successful for us because, again, these organizations need to be going to that stage and after getting that seed capital. And then we also have our fund, and this is one thing, there are actually a lot of funds in places like India. But if you come out of India, there's not that much. So you do need that. This is where that whole private equity funding comes in, right? And so you need that fund money. And then lastly, you need to have structured products. Okay, that's what's known in the finance world, structured products, whether you have an initial public offering or just, having a bond structure that can be floated in the market, and which we obviously do as well. So all of this, if you look at it, all of this, and we have done various things and, had success with it, but all of these are in every stage, meeting the Sustainable Development Goal. Why? Because every single stage of the growth and every single interaction is focused on achieving a social and environmental return. So it's really, really, really amazing to see how we see it every single day, how we are sort of playing an incredible role in achieving the Sustainable Development Goal. So the current trends, in impact investing that that you can see, the impact investing trend that kind of translates into SDGs, you do see that impact investors, they are happy. They're actually, you can see more and more people coming in. Once again, there's different behavior with different investors in different regions. We'll go a little bit more deeper on that later on, but it is happening. You do see that there's now entry of large, sort of financial firms who are coming in. Once again, you need to have the structured products for them because they can't just invest, $200,000 or so. They come in for millions of dollars, but you need to have the right products for them to do that. There's also, we do see in general, there's a genuine commitment towards SDG. We hear this now continuously from a lot of the private sector players, and they want to do something about it, and they do see that impact investing is a way to do that. In doing that, initially, the only way they could do it was through CSR, but now they say, oh, you know what, we can actually be an active investor, or even through our philanthropy, we can catalyze some of these investments, because a lot of you still need philanthropy dollar to catalyze the market, and I think that's starting to happen, and people are really starting to embrace impact measurement. This is something that we'll spend a lot of time talking about, because we have been very successful in terms of making impact measurement a really part of the conversation, with the financial return. Because honestly, if you can't measure something, it's very, very difficult to value it. So given that the impact measurement that we have, it goes hand in hand with the financial returns, this has been a fantastic element in terms of also growing the work on the impact investing space and making it go hand in hand, with the SDGs. And I think, just very, very quickly, if you look at the SDGs, that the impact investment is, I would say, sort of actively, helping, is really, at SDG number 8, looking at the decent work and economic growth, and then moving on to 1, 7, 10, 5, and 13. So really, gender, climate, poverty, etc. And then, interestingly, also some of the advocacy work that's happening, with impact investing, it is starting to touch on, peace and justice. It's touching on looking at the cities, which is, as we know now, most of the world population are now living in cities. And then the most, I would say, interesting one, which again is not that quantifiable, in itself, but playing a big role, is really partnership. We do see various groups of partners coming together and making a lot of these financial instruments and a lot of these initiatives that are happening, that are meeting the SDG, looking to meet the SDG goals. So these are all very, very positive, and we're very excited to be a part of it. And then looking at in terms of where the sectors the money went into, and again, keep in mind, this is, once again, the chart I feel is a little skewed, because you'll see that a lot of funding has gone into microfinance, as you can see here, which of course does meet one of the SDG goals. But microfinance, I always say, is sort of the grandfather of impact investing. So it just does one thing, which is the financial inclusion. So it's really does not represent every sector. But microfinance has been around for 40 years. So it continues to get funding. And then the next most popular thing is energy, and we do see that quite a bit even in Asia, that the clean energy is a big push. And then the low-income housing is another one. And then the rest of it is very low. And so it really is, there's an incredible need on the healthcare side and the education side, in agriculture, water, sanitation, etc. And those are still really not being met, meaning that the investment is not going there still in a large amount. So that means what we are seeing is there's a gap, and we can be, if we have the right ecosystem, if we have the right structures, we can actually push on it and make sure when we look at the numbers again a few years from now, that we have a more of a balance approach. But the good news is, obviously, you can see all the investment that has come in has most effectively touched on every single SDG, and again, that is very encouraging. And the other thing which is very interesting in these charts, and you don't see it, but in the information around it, is still a lot of the funding is going in the early stage, which is fine. But again, as know from the lecture and from the reading, that you need to really look at it as a whole ecosystem, and also sort of the supply and the demand side at different levels. So really looking at the entire value chain. So it's not only about just the growth, the early stage, the seed stage, but really looking at the entire value chain of social capital markets and all that is needed to happen on that, be it the right structure, be it the impact measurements that needs to go in to make it happen, be it actually even some, a lot of the philanthropic money that needs to go in to catalyze, some of the later stage growth. So all of that needs to be, kept in mind, because it's not, this space cannot be growing in sort of, in one step at a time. We need to have all of these happening simultaneously and in parallel. So what are the ingredients for closing the Sustainable Development Goal financing through impact investing?
Well, it really is a myriad things. I mean, you have to pull together. It's like really almost making that incredibly wonderful, dish, because you are bringing in so many different things to make this happen, and so many different players who have different agenda. But first and foremost, you really need to have a common understanding in terms of what impact investing is and what does it mean for the different group. And then you need to figure out in terms of, are there certain structures that will enable all these different players to be working together? Are there high quality investments which will actually allow for certain SDGs to take shape? Are there actually professionals who will be able to do some of these works? Are there sufficient capital to get this off the ground, to do the initial research, to actually figure out what structure is needed, to actually then pull the pieces together? What's the impact assessment methodology? What will be the exit option, meaning how will actually the investors make money? Because they will be giving money through whatever the structure is in order to make sure this SDG goal is happening. What is sort of the enabling political environment? Is actually the public policy and the politicians and the bureaucrats, are they actually for it in these certain countries that we are working in? Are there enough market research or data to back this up so the investors feel comfortable? And of course, very importantly, among all of these things, are we meeting the SDG goals, and very specifically the SDG 5 for the gender lens investing? So you have to make sure all of these things are working together and the pieces are coming together in order for us to really jump in to use impact investing as a solution to meet the SDG financing.
So SDG 5, the Sustainable Development Goal, is the gender for women and looking at gender equality. And it is actually, interestingly, if you look at it, this is an entryway to few of the other SDGs. In other words, if you really focus on gender equality, you're not only doing that, but you're also touching on SDG 8, which is good jobs and economic growth. You're touching on good health, because frankly, if you're looking at gender equality, you're also thinking about accessibility to good health care, among many other things. You're also touching on quality education, because again, you need, if you're going to be getting, if you're looking to invest in gender and really bringing women up on the ranks of social equality, education is one of the big needs. Zero hunger, so again, sustainable agriculture, which is, again, women are a big part of that equation, is met. Climate action, SDG 13, and again, interestingly enough, if you think about it, all the climate issues that are happening, while it impacts both men and women, but interestingly, the women get impacted a lot more, given that they're the ones who are having to take care of, a lot of times, the family and the aftermath of the house kind of going underwater, or losing the livestock, etc. And then, of course, in terms of the peace, justice, and strong institutions, it's a given fact that if you invest in women, that also contributes to sustainable peace, because women tend to work within the community and bring the community in. And then, of course, the most important one, which is the SDG number 1, which is no poverty. You invest in women, you will actually see that this is a more equitable growth that happens, where it's not only just the women, but the family and the community that comes into the equation. So all of this really has very important implication in terms of looking at gender and looking at women and investing in them, and really seeing the ripple effects in terms of not just one investment and meeting one SDG goals, but in effect, you're meeting many of them. So this is really something that is extremely powerful, and of course a necessity for us to have a sustainable planet. Going a little deeper, so now we have touched on the SDGs, we have touched on looking at investing in women. So what is genderless investing? It really is using gender as a category of analysis. So really, in this case, using women to create both financial return, and then also which will make an organization that's working with women more sustainable financially. And then also making sure that there's positive social impact on women and girls, and which is not stated here, but it's sort of implied in the work we see that happens on gender, is also that has an impact on the environment, on the climate. So it definitely is there. So the pillars of gender lens investing are access to capital, where you're investing in women owned or women led, or frankly women beneficiary. That's also very, very important. So it may be the management may be men, but you can have thousands of women who are benefiting from the company. So that's also falls into the gender lens. Workplace equity for women, again, where women are treated equally in terms of pay, in terms of board representation, in terms of working with women owned, led, or impacted entities in the supply chain. And then also looking at products and services for women and girls. So again, investing in enterprises that offer products and services that usually is not looked at or ignored, and so far has been ignored. And so really looking at things in terms of a perspective, of women. And so a lot of this, again, may focus on women's health and women's hygiene. And once again, these are things that were not really looked at or focused on before. So this really creates, in terms of access to capital, workplace equity for women, and product and services, all of these are the core, of looking at sort of gender lens investing in a holistic way. Now, if you look at sort of the trends, in the gender lens investing and the SDG, you'll see that gender lens investing now is really getting a lot of momentum, and it is emerging as a distinct practice among investors. And as we touched on before, the SDG 5, which is women, I mean, this is actually a very significant SDG, and obviously UN Women is one of the bodies who is really pushing on this. But the reality is, gender inclusive approach to market-based sort of financial instruments can really play a significant role in promoting women's empowerment. And there are two trends to sort of kind of broad trends to take note of. One is sort of investments in gender lens instruments are increasing, be it from private sector, venture capital, and private debt. Again, when I say increasing, let's pause on that. It's the intentionality. They're thinking that they're going to be doing more or trying to do more, with an increase of diversity of offering, but there's still a lack of sort of uniformity in investment process and definitions. So in 2018, one report estimates that there were 87 total funds deploying capital with a gender lens, up from 58 in 2017. And that number is on the rise. At the same time, interestingly, approximately 50% of the funds included all 5 of the surveyed classification in their definition of gender lens investing, suggesting that the definition of genderless investing is very broad. There's also an interesting shift in looking at genderless investing as simply bringing in more women leaders. So you'll often hear, yes, this organization is, gender friendly or looking to invest in gender lens just because this other company, has a woman, in their board. So it really is, as I would say, there are various shades of gender lens investing as there are various shades of, impact investing. Now, the second trend is that gender lens investing is taking place across all sectors. And we do see that, in technology, health, energy, healthcare, being the 4 largest specific sector themes. However, the specific impact on women still remain quite broad. So it's more breadth than depth, highlighting the importance of being able to really measure and track the real impact that's happening on the women's lives through these investments. So these are all sort of things to keep in mind, as this space is obviously here to stay and growing, which is all good news, but obviously we have to really keep in mind the depth of the impact on women's lives. Now, applying kind of the gender lens investing into the various investment decision, you can actually look at gender as a screening. You can use restrictive screening to avoid investing in companies with poor gender diversity records, such as weak policies or supply chain sort of safety records, or if they have women in them, if they're actually looking after these women workers. Case in point, as we are all well aware, the whole garment industry is frayed with various inefficiency in the supply chain and ineffectiveness in terms of how they treat women. Also, gender diversity in leadership. So investing in companies where they have leading gender diversity records, including strong policies and programs, and frankly, diverse boards, and management. So that is a big thing. So if nothing else, you kind of start up at the top, and you do see when there are more women on the top, they tend to bring more women in, and they tend to have policies that are more gender friendly. And then in terms of sort of the proactive investment, if you really seek out to drive greater gender equality by providing access to capital or targeting companies that provide services benefiting women. So listen, it may not have management, they may not have women in it, but what they may have is it may be a product or service that's actually beneficial to women. Because again, we have to keep in mind, it's interesting, given global statistics, over 70% of a household purchase decisions are made by women. So if you think about it, the reality is more companies than not are touching the women's lives, and these women are making a decision by buying their products. So we do have to keep that in mind, and that actually is the case even with the folks in the lower stage of economic growth, because women do make decisions on the purchasing side as well for the family. Now, recapping this module, so we actually saw what we learned about today is about the Sustainable Development Goals, what it means, the funding gaps, and the role of impact investing and all of that, how it can help and meet these funding gaps. We learned about the impact investing as a sector that goes beyond the traditional investment with an aim to achieve more of the social and environmental impact, and how it's being done and also bringing in the financial return. And we understood the role of gender-led investing, again, a topic and activity that is here to stay, so which is very important. And we do need to understand this in achieving sustainable development goals and how it can be also incorporated, in your investment decision. So I hope you actually enjoyed the module, and look forward to the next one.